You know, an asset class has to be smoking hot anytime American Express, literally a financial institution that doesn't have any type of mortgage wing, was making offers for you to close on your next home loan. That having been the case, residential real estate is a hot asset class right now. It's so hot right now to the point where it's the most unaffordable it's ever been in US history. And the reality of the situation, if you're middle class, working class, if you're not already rich, real estate is the top asset that is most accessible and the most attractive for you to increase your net worth. And it's also going to be the biggest stabilizing factor in your overall finances when you can start to get on a property ownership ladder. That having been the case, as I just mentioned, affordability is at its absolute worst in the US housing market. So the elephant in the room is, how do you afford your first or next residential property? That's what I want to cover in this video. I want to cover all of the factors that affect affordability so you can try to manipulate those factors in your favor to help you qualify for your first or your next home. That having been the case, I'd like to give context on who I am so you know who you're getting this content from. My name is James Phillips. I'm a banker and financial services professional by trade, over 13 plus years of experience at the time of this recording. I do hold an active mortgage loan originator's license in my state. 771386 is my NMLS number. Active FINRA Series 6 investment license. Also small business certified, helping small business with banking, cash flow, and lending needs. I've taken my own personal credit score from a 515 FICO score or lower about 7 to 8 years ago to over 780 across the board plus, as well as my net worth from negative territory, about negative 5 figures, to plus 6 figures in about the same window of time. So not only do I have real world experience in the financial service and banking industry and the lending industry, well over a decade, but I've taken my own finances from negative net worth territory, negative FICO scores, all the way up to a surplus range of 6 figures in net worth, as well as FICO scores 780 plus, which is prime credit. So that having been the case, you know you're getting this information from somebody who not only has industry experience, but real life experience. So the elephant in the room, as I mentioned, is affordability when it comes to the residential housing market. And the reality of the situation, it couldn't be worse than it is now. Not only are interest rates as high as they've been in over 2 decades, but prices of homes themselves have still accelerated, with interest rates being higher than they've been in a long time. They're still accelerated to the highest heights they've ever been. It's over $400,000 for a residential property in the United States as the median housing cost. That having been the case, what are the factors that affect affordability that are holding many of us back from owning a property or selling an existing property and moving on to the next property? Well, that list is going to be everything from your annual income, monthly debts, down payments, debt to income, interest rate, loan terms, PMI, and escrow, think taxes and insurance. We're going to break each one of these down, and we're going to talk about what it's going to take to manipulate these in your favor. And then we're also going to talk about how banks and your local, state, and federal government are clamoring to try to put money towards you closing on your next property, and a little bit on why. So when you think about annual income, this is a very big part of your affordability factor. You need to have a stable, consistent income. If you're looking to qualify for a home loan from the average bank that's out there, even if it's coming through an independent mortgage broker or you walk into a physical financial institution, if you're dealing with the average bank out there and you're doing a standard loan, think FHA, VA, conventional, any of those, you're gonna need to show 2 years of income. And when I say 2 years of income, it's the same type of income. Think from a tax perspective. Are you W-2 tax? Are you 1099 tax? Are you getting a Schedule K from a business? Whatever the case may be, you need to have it for 2 years. So a stable income, and ideally same industry, job history, it's important. You have to be able to demonstrate stability by being in the same career field for at least 2 years in most cases. Or you have to have a really good justifiable reason for switching industries. As I've mentioned in previous videos, you also want to be cognizant of switching between taxable income forms, meaning if you go from W-2 to 1099, you're resetting your clock on your 2 years. So you're putting yourself in a pretty bad position in most cases in qualifying for a home if you do that. Going from 1099 to W-2, on the other hand, is the opposite. You can do that and qualify within 30 days or so because you have a W-2 income and you can provide, the documents showing that you have a stable income. So the next thing you need to focus on is making sure that that income is as high as possible. It's going to be pre-tax income that you're judged by. So the important component with that is going to be making sure you have all of your ducks in a row. So you want a stable income, you want it to be as high as possible, and it's going to be before taxes and deductions are taken out, how they're going to count that income. So you have to underwrite for yourself, by the way. This is an important keynote. You have to make sure that even though the bank is saying you qualify for X amount of home based on your income before taxes and deductions, you know your take home is a fraction of what you actually make in gross. You have to determine, can you really afford the home that the bank is saying that you can afford? So when it comes to that, this is going to be a very important component in annual income. It's everything that I just gave you and some more context that we're going to cover in a couple other bullet points. The next one is going to be monthly debts. So this is going to be a big one as well. Out of that gross annual income, there's going to be these parameters put in place that mortgage companies are going to say, I don't want you spending more than X amount of percent of that gross annual income on your mortgage or your overall debt load. So in many cases, it be ratios like, 36 and 28, front end and back end ratios, meaning that the total debt expenses and the mortgage itself, no more than 36% of your total income going out to expenses and bills, and no more than 28% going towards your mortgage. Those numbers fluctuate based on the loan program. It's a little different for USDA, VA, FHA, and conventional. But that having been the case, they do care about that. So your monthly debt load is going to be anything reporting on your credit report. They're not looking at, your discretionary and disposables like your cell phone bill and groceries. Even though you need to be looking at that, the mortgage company's not getting that deep in the weeds. You just need to be focused on your monthly expenses reporting on your credit report. So think credit cards, student loans, auto loans, personal loans, other mortgages, etc. These are going to be the things that other financial institutions are going to look at, or your underwriter is going to look at and say, this is what we're leaning on to make sure that you can afford the payment that we're about to agree upon, the terms that we're going to provide you. So you can influence things when it comes to your income and your monthly debt expenses by either increasing your income or lowering your monthly debt expenses. Ideally, you would do both, but you can manipulate your affordability by influencing one of those factors. I tell a lot of my clients all the time, listen, if it's too challenging for you to make the moves necessary to get rid of some of your monthly debt, at least increase your gross income. Go out and get a side hustle that's verifiable, ideally W-2. If it's going to be 1099, realize you're going to be working on a longer clock, but go out there and increase your income to the best of your ability. Work overtime at your job. You have to have that for a couple of years as well. Any commissions or overtime, you have to have that for 2 years as well. So that's a keynote back on that annual income bracket. But increase your income or lower your expenses, or ideally do both if you want to affect your affordability by tens of thousands of dollars. Just a few $100s a month in either direction can affect tens of thousands of dollars on a loan because it's being amortized over 30 years. So they're looking at those numbers playing out over 30 years. It's a little crazy, but it's just the reality of how the lending space works with mortgages. So again, if you want the opportunity to afford $10, $20, or $30,000 more in home, then you might want to move the needle $250, $350, $400 a month in order to accomplish that. It's not crazy, believe it or not. A few extra hours a week at work or some side hustle, or paying down a few credit cards or paying down a personal loan or paying off a personal loan or auto loan can make a big difference in the neighborhood you end up in, the quality of your home you get. So next is going to be down payment. This is a big one as well. Down payment is going to be obviously the cash that you bring to create equity in that property or buy that property with equity. Mortgage loan programs start as low as 0% for down payment programs. There's several of them, VA, USDA, even some conventional now in this current housing market are at 0% down. Then it goes up to FHA with 3.5%, conventional goes up to 3%, on and on. The moral of the story is many times than not, you're gonna need some kind of cash for down payment, or this is where it gets a little exciting. Banks and the local government will work with you and put cash in your pocket to provide your down payment. Many banks will offer $2,500 up to $7,500 towards down payment or closing cost assistance themselves, combinable with city, state, or sometimes federal first-time home buyer or grant programs, or sometimes forgivable loan programs that will put that money in your pocket towards your deal, supply your down payment or a chunk of your down payment, as well as help with your closing costs, which is another component affecting the overall deal itself. So this is where it gets exciting. Doing your homework on the financial institution you already bank with is going to be important. This is why I like working directly with financial institutions. Loan brokers can still be great, but many times the financial institutions you're banking with will be offering thousands of dollars to help you get into a home. So if you don't have a lot of cash, don't let it be a deterrent. Even though it's an ideal scenario, for the next metric we're going to cover, one of the next metrics is going to be PMI. When you have 20% or more down in equity, you can get rid of PMI, which is a cost that affects your affordability as well, and really just kind of takes money out of your pocket because you're insuring the lender with PMI. But we'll get into that a little bit more in a moment. With the down payment program, I am an advocate. If your finances are healthy otherwise, and you can get the bank and the local government or the state government to put their money together and get you into that home without you putting much money down, as long as you actually have cash reserves to buffer yourself and to buy the furniture in the house and those other expenses, as long as you can actually afford it, I'm all right with it. I think it's a good idea because your money can be going elsewhere. You don't really need it trapped in your equity because you can't eat your equity. That's something we say in the mortgage industry all the time. So I'm not a bad proponent or a negative proponent on not putting much cash into your deals when it comes to buying your primary residences. Because at the end of the day, unless you're selling a property and going to be rolling over equity that you got from a previous property, if you're buying your first home, you might be in a situation where your credit's good, your income's stable, your expenses are manageable, but you just don't have a ton of cash saved for various reasons. I mean, in the expensive world that we're dealing with, in a society where inflation is through the roof, it's totally understandable. I don't want that to be an obstacle for you getting on a property ladder and building equity and building wealth in this system through residential real estate. So that's going to be a little bit on the down payment side of things, but it can affect your affordability because it's that much less loan payment that you have to worry about. So the next component is going to be your debt to income ratio. So that was just similar to that monthly expense conversation we were having. Really, annual income and monthly expenses, DTI, debt to income ratio, that's what's being covered in that scenario, where I kind of broke down that 36-28 or 50-43, whatever those ratios might be, where the mortgage company doesn't want you overextended on your monthly expenses, including the mortgage payment, when signing up or when applying for a mortgage, because again, they want you to be able to afford it for 30 years. So your DTI is going to be your debt to income ratio, your monthly debts reported on your credit report against your gross annual income. You want to have as much of a spread between the two of those as you possibly can. So that's where you can either lower your monthly expenses or you can increase your annual income, or you can do both ideally in order to benefit yourself on DTI. This is the most impactful single factor on your affordability is DTI, believe it or not. You can get around down payment. You can get around the next ones we're going to cover, like escrow and P&I, principal and interest, as well as PMI. But it's really hard to get over a bad debt to income ratio. Really hard to get over that one. So the next one we're going to cover is going to be your interest rate. Interest rate is going to be affected directly by your credit score for the most part. So when you think about your interest rate, they're as high as they've been in over 20 years at the moment. Due to some economic factors I've covered in other videos on the channel, we're not going to dive into it right now. But interest rates are historically average, but they're high for the last 20 years or so. And so when you think about how that affects it, it basically balloons your payment. When you have higher and higher interest rates, that is inflating your overall monthly payment, which affects your monthly DTI. It affects your debt to income ratio that I just told you is extremely sensitive and important in this process. So you have to be mindful and cognizant of trying to have the best interest rate you can, and that's largely predicated on your FICO scores. So this is where all three of your primary FICO scores are pulled together, and the middle of the three is pulled to determine your interest rate. You have a 700 over at Equifax, you have a 760 over at Experian, and you have a 725 at TransUnion. The 725 is going to determine your interest rate on your mortgage loan. So the bracket that you want to be in is 760 or higher for FICO scores to get the best available mortgage rate. 760 middle FICO score or higher will get you the best interest rate possible. This is going to put you in a position where you can bargain and negotiate your way through on a loan in other areas. When you have prime credit like that and a good stable income, trust me, the bank and other, the person selling the home, etc., are going to try to work with you in the cash department if you don't have the best down payment scenario, if your other markers are strong. So in order to make sure the interest rate works in your favor, this is another one of those factors that just a percentage in one direction or the other can be tens of thousands of dollars on your home because it's that much of an effect on your payment. So you want to have a good FICO score, 760 plus, to get the best loan terms possible, interest rate in particular possible. Next one that we're going to cover really quickly, loan terms. So this one is going to be relatively quick, but it is very impactful. Most of the time you hear about 30-year fixed rate terms. There are shorter and alternative terms, anything between 15, 30, and there's even been rumblings of a 40-year coming out for different reasons to help with affordability. It's not something fully in the marketplace to my knowledge, but it is something that's being touted and being and kind of being experimented with in the mortgage lending world to help with affordability, because prices and interest rates are both through the roof, and the system wants you to continue to buy homes and afford homes. So pushing out the term broadens your affordability. 15-year term is less interest costs, which is a tremendous benefit, but it nearly doubles your mortgage payment. When you have a 30-year fix, you have way more affordability because the payment is much more stretched out versus being condensed or consolidated, ballooning it, but you pay a lot more interest if you stick out through that whole 30 years, a lot more interest. So you have to juggle what's important to you. Many people don't stay in their homes more than 7 to 10 years in this country. So the reality of it is, in most cases, is you'll probably be in a scenario where you do the 30-year just to be able to afford the property and stretch your payments out, but you're probably going to sell it before you end up getting stuck with all of the interest costs, even though interest is front-loaded on your loan and you will pay a bulk of it up front. You won't pay all of it if you are going to either move out and sell that property in X amount of years, or you're going to pay it off sooner. So that's going to be your term part. That's about the nuts and bolts on term, but it can affect your affordability greatly. The next one we're going to look at real quick is PMI. So with FHA loans, you're stuck with MIP, which is the variation of PMI, which is private mortgage insurance, which is insurance that protects the lender in case you default on a loan. With FHA, you're stuck with it for the life of the loan. Conventional loans, if you're 20% in equity or better, then you can avoid PMI, which can be a nuisance of a cost. It's usually less than $100 or $100 and something bucks a month in most cases. It's not like crazy. It's like a small fraction of a percentage of the loan, but it does affect affordability a little bit, and it's an unnecessary cost that you're paying or bill you're footing to protect the lender in the case of default. And so if you can avoid it, then that's what you want to do. This is where a good down payment or buying with equity can go a long way on a conventional loan. Now, if you get an FHA, that's fine. It may help you get into a property you normally would not have gotten into, but you have to turn around and try to refinance out of that at some point in time if you want the benefits of getting rid of PMI. So that's about the nuts and bolts on PMI, but it can have a noticeable effect on your affordability. So the next one is going to be escrow that we're going to cover. You have stuff like HOA as well, but escrow is going to be taxes and insurance. So property taxes, homeowners insurance, flood insurance if you're in that type of hazard insurance, etc., depending on your geography. This is going to be another big one. I mentioned in a previous video how escrow is killing homeowners in my state and across the Gulf South. Because we are prone to hurricanes on an annual basis, insurance companies are getting wiped out with having to pay claims at scale on a frequent basis, more than they can afford, and going bankrupt, leaving very few insurance companies in the marketplace, which is jacking up prices. It's supply and demand. There's only a few of them offering it, and it allows them the ability to pass on the higher cost of paying out insurance claims through premiums. And mitigating the risk and dealing with the higher risk level by pushing it off on us as the homeowner. So escrow can be a powerful influence on affordability. You have to do due diligence on where you're buying your property. You ideally want to buy in the area that is the least affected by negative weather patterns to the best of your ability. For us, that's going to be moving out of flood zones to the best of our ability. And that's not easy to do because some of the more attractive areas might be in the flood zone. So, you have to do your due diligence based on your geography. It could be fires where you are, tornadoes where you are, whatever the case may be. There's usually some kind of factor that is affecting insurance costs. And then you have to be mindful of being in a county or a parish, in our case in Louisiana, with high property taxes. Most of the time, this is going to be states with no income tax, state income tax, that have the highest property taxes on average. But we are experiencing high property taxes in my state and my general regions in the metro area of New Orleans. So you have to do your homework on that before you buy while you're shopping. Escrow can kill you. It can literally outdo your PMI if you're not careful. You can end up paying more in taxes and insurance than you pay in principal and interest on the property. Have to do your due diligence on that. Have to do your homework and make sure that you're buying in an area that is lowest risk in insurance costs and lowest costs in taxes as you can possibly put off. So those are your big affordability factors. Banks, governments are incentivized to help you get into homes because homes, residential real estate, as well as all forms of real estate, are huge proponents of the growth and stability of the economy. They generate a lot of tax revenue. They create a lot of jobs. They support a lot of industries and small businesses. Just homes alone, one single residential home is worth a lot of tax revenue, a lot of business development, and a lot of economic activity is wrapped up in residential real estate. So banks, local, state, and federal government will continue to incentivize us to own property. They give us tax write-offs. They will give us cash to close, etc. And there's a lot of support if you can't afford the payment down the line and the life of the property. Because at the end of the day, vacant property kills everybody. It hurts the local neighborhoods of values. It hurts the fact that it's not collecting any tax revenue, which affects the local infrastructure. It affects the economy. There's small businesses that are dependent on people owning homes. So whenever there's vacant property, it does nobody any good. So there will continue to be programs in place from bank and financial institutions. You know, even like I said at the beginning of this video, American Express, literally somebody that has not a horse in a race on mortgages partnered with a Better Mortgage at one point in time and was offering up to a $2,000 to $6,000 incentive on helping you close on homes if you did a deal with them as an affiliate with Better Mortgage, for example. So banks and financial institutions, as well as the government, will continue to incentivize it. You do your due diligence and your homework in your local arena, the real estate market you're interested in. I guarantee you'll find banks and you will find government programs to help put money in your pocket to close on a deal so you can increase your net worth, stabilize and advance your finances, and create a legacy for yourself and your family. So I want you to comment down below and let me know what your experience has been in trying to advance your financial net worth in real estate. Do you own property? Have you had a hard time? Or do you have plans on buying your first property, selling your existing property, going into your next? I want you to comment down below on that. Let me know what questions I can answer for you or what assistance I can provide in these videos to help you get in better position to buy your first or next property. Comment down below. Other than that, I'm grateful for every single one of you tuning in. To all my pioneers, welcome back. To my new viewers, welcome in. I want you to continue to support the channel by commenting, sharing, and subscribing so the channel can keep supporting you. As always, I want each of you to stay focused, stay in motion. I'll see y'all soon.